Welcome back to the MLD Wealth Podcast, Money Matters. I'm Chad Larson, your host and Senior Portfolio Manager at MLD Wealth. And today I'm going to do my annual year-end review and outlook, our most comprehensive episode of the year. 2025 was a remarkable year for markets, but also a clarifying one for many investors. In many ways, it was a year when fundamentals mattered again: supply, demand, cash flows, capital discipline, structural constraints, and real assets took center stage. This episode will break down what actually drove returns in 2025, why leadership broadened far beyond technology, the resurgence of gold and precious metals, and why bullion hit new highs, a deep dive on energy, integrating our investment memo comments from earlier last month, how international equities, especially German and Japan, reemerged, the growing strategic importance of defense, aerospace, and infrastructure, what went wrong in private markets, and why good advisors must do differently, and of course, our 2026 playbook: disciplined, diversified, and intentionally positioned. This is going to be a detailed discussion. Whether you're a client of MLD, another advisor, or someone who simply wants to be a better steward of capital, you're going to get a lot of this episode. So let's jump right in. So, section one, what really happened in 2025? 2025 will be remembered as the year that leadership broadened. For the first time in a long time, markets rewarded real assets, commodities, precious metals and gold miners, financials, industrials and exporters, aerospace and defense, utilities and power producers. Yes, technology played a role, and I'll speak to that in a measured way later, but the dominant story was the return of fundamentals and scarcity economics. Several forces converged this year. Inflation remained sticky, but not runaway. This supported pricing power for hard asset sectors. Interest rates stabilized, providing visibility for capital-intensive industries. Geopolitical tensions pushed investors towards resilience assets: defense, nuclear, energy infrastructure, bullion, supply chain independent producers. Underinvestment from 2014 to 2022 created supply shortages, and this was especially true in energy and metals. Fiscal spending accelerated, particularly in Europe and Japan, and defense budgets broadened worldwide. The US dollar began to soften, a major tailwind for gold and international equities. These are structural forces, not short-term narratives. Section two, I've spoken about this a lot through this year: gold and precious metals, a renewed bull market. I want to talk about gold because 2025 was a breakout year for bullion and equities, and one that we anticipated well ahead of consensus. So why did gold break out to all-time highs? Well, one, a weakening US dollar. Several global macro shifts pressured the USD, narrowing growth differential between the US and the rest of the world. Rising deficits, political volatility, international diversification away from USD reserves. A weaker dollar is almost always constructive for gold. Central banks were major buyers again. According to the latest data, central banks, especially in emerging markets, continue to accumulate gold at a historic pace, and even things like Tether and stable coins in the crypto world accumulating gold. Why? Well, a distrust in global reserve assets, geopolitical hedging, and diversification away from the USD and USD treasuries. The need for universally accepted collateral. This is critical. Gold's price today is being set not by retail speculation, but by sovereign demand. Real interest rates stabilized. As yields stopped marching upwards and inflation moderated, real rates stopped suffocating bullion. That shift unleashed gold's upside. Geopolitical escalation created a flight to quality. Investors worldwide increased allocations to precious metals as geopolitical conflicts intensified. Gold regained its traditional role as a store of value, a geopolitical hedge, a volatility dampener, and a long-term inflation anchor. So what about gold miners? Well, 2025 was a turning point for miners because margins expanded with higher bullion, cost inflation stabilized, free cash flow improved, balance sheet strengthened, and M&A activity reaccelerated. Miners went from being ignored into cash flow machines. We believe this trend continues into 2026. Our allocation MLD portfolios have active gold exposure, and we remain bullish into 2026. Gold, again, it's a hedge, it's a store of value, it's a geopolitical insurance policy, a portfolio diversifier, and one of the few assets not reliant on another party's promise. This is not a tactical trade for us, it is a part of our strategic allocation. I want to talk about in section 3 energy, revisiting the fundamentals. Energy was one of the most compelling sectors of 2025 and remains one of the most asymmetric opportunities heading into 2026. Why? Structural underinvestment. From 2014 to 2022, the global energy companies endured things like ESG pressure, regulatory hostility, capital flight, low commodity prices, and shareholder demands for return of capital over growth. And as a result, exploration budgets collapsed, development capital stalled, inventories declined, spare capacity shrank, refining capacity fell offline, pipeline construction slowed. We effectively starved the sector of capital. 2025 exposed that mistake. Supply cannot easily respond. Even with higher oil and natural gas prices, new fields take years to develop. LNG export terminals take 5 to 7 years. Pipelines require regulatory approval and multi-year construction. Refining capacity expansion is structurally constrained. Global shale productivity is falling, and geopolitics restricts supply. The Middle East, Russia, and West Africa. In short, you cannot flip a switch to increase supply. Demand remains strong and persistent. So, despite headlines about renewables and electrification, global oil demand set new highs in 2025. Aviation fuel consumption rose sharply. Petrochemicals demand increased. Diesel consumption surged with global trade recovery, and natural gas remained the backbone of global electricity generation. And importantly, as I mentioned in my last segment, AI data centers are enormous energy consumers, not just for electricity, but natural gas and LNG indirectly. Energy demand is not going away, it is growing. Energy companies have become more disciplined than ever. And this is a key point from our energy investment memo. Energy companies are no longer chasing growth at all costs. They are returning capital to shareholders, limiting capex, focusing on high return projects, strengthening balance sheets, and generating record cash flow. This capital discipline supports sustainable dividends and buybacks as well. So, geopolitical risk is now a permanent risk premium, whether it's Middle Eastern instability, Russian supply disruption, US China tension, shipping lane insecurity, OPEC plus policy unpredictability. Energy markets now price in a persistent geopolitical premium. Investors need to exposure to assets that benefit from this environment. So our positioning in energy, MLD portfolios maintain exposures across integrated producers, midstream pipelines, LNG exporters and operators, natural gas infrastructure, diversified energy royalties companies, select refiners, uranium producers for nuclear baseload, copper and materials tied to electrification. This is a balanced barbell: traditional energy for cash flow, nuclear uranium for baseload, natural gas for bridge demand, and materials and copper for modernization. We expect energy to remain structurally attractive into 2026 and well beyond. I'm actually excited. Next month's podcast, I'm going to have a special guest. We're going to do a very deep dive solely on the energy market, and I can't tell you how excited I am for next month's segment. And he's really going to set the table for of how we feel. We're about 5 years into a 15-year bull market in energy. So, Section 4, international equities. You've heard me pound the table and speak on this in previous episodes. So a return to global multipolarity. For over a decade, U.S. equities have dominated global returns. 2025 marked a shift, not a reversal, but a broadening. So in Germany, we saw massive fiscal activation, industrial investment revival, infrastructure spending, defense rearmament, improved energy security, revitalized export competitiveness. Germany is quietly entering a multi-year modernization cycle. Japan became one of 2025's most consistent winners. Why? Massive corporate governance reforms, record share buybacks, unwinding of cross shareholdings, renewed inflation, higher wage growth, improved return on equity. Japan has become investable in a way it hasn't been for decades. And a weakening US dollar supports global assets. As forecasted in our 2026 long term capital markets assumption piece that I published, the dollar strength is likely past its peak, supporting international equities and commodities. At MLD, our international exposure reflects selective Europe, Japan, global industrials, exporters, and international dividend growers. International diversification is not optional, it is essential. You heard me speak about defense, aerospace, and national security. Defense was one of the most important yet under discussed asset classes of 2025. Global tensions escalated, NATO countries increased spending, Asia Pacific names rearmed, cybersecurity threats expanded, space defense became a priority. Defense companies now have multi year order books, strong cash flows, long duration visibility, rising global demand. This is secular, not a cyclical theme, and we maintain strategic exposure to aerospace manufacturers, missile and defense systems, cybersecurity, intelligence and surveillance technology, and space based infrastructure. Defense has been moved from nice to have to core portfolio exposure. Section 6, infrastructure and power. This is while AI still gets all the headlines. It was 2 segments ago I really gave a deep dive on our thematic portfolio and around AI and infrastructure, but the real story is global power shortage. Countries are now confronting a major truth: we do not have enough electricity generation or transmission capacity. This is driving massive utility capital expenditures, grid modernization, nuclear restarts, natural gas pipeline expansion, copper demand accelerating, public infrastructure spending. Infrastructure is not a theme for 2026. It is the next decade, and MLD portfolios maintain exposure accordingly. Section 7, private markets and lessons from 2025. I didn't take a lot of heat, but I definitely got in front of some of the headwinds that were starting to bubble up in and around the thematics of private credit. But the private credit industry hit turbulence this year, not because the assets were poor, but because the structures were flawed. We predicted this in our educational memo: liquidity mismatches, gated funds, redemption queues, NAV financing dependencies, duration mismatches, and advisor misunderstanding. Many advisors simply did not understand what they were selling, and this created pain for clients, not ours. MLD's advantage is structural literacy. We only invest in institutional quality managers, closed end vehicles when appropriate, transparent structures with realistic liquidity frameworks, and strategies with proven underwriting discipline. 2026 will separate strong lenders from weak ones, well built funds from poorly designed products, and advisors who understand structure from those who don't. And this is a healthy evolution. I want to spend a bit of time on MLD wealth and on people, process, and philosophy. I'm so honored to be able to share and build this, along with my partners. But I want to talk about what differentiates MLD. It's our people. We operate as what we call an OCIO or MFO. That's a lot of jargon, but as an outsourced chief investment officer and as a multifamily office, clients get portfolio management, research, risk oversight, direct accountability, and global due diligence. This is not product distribution. This is real portfolio and risk management. Within process, our edge has been consistency. Every portfolio decision flows from risk budgeting, allocation discipline, liquidity management, scenario analysis, stop loss frameworks, and behavior discipline. Process removes emotion, process removes noise, and process compounds returns. Within philosophy, our philosophy has been simple: discipline outperforms, not speculation, not yield chasing, not trend following, discipline. Discipline has been that word in my life that has made such an impact. Discipline, more than hard work. Discipline is not intention. Discipline is showing up routinely and doing the hard things when it matters and when no one's looking. And in 2025, that philosophy delivered. Section 9, our 2026 outlook. And I alluded to this. I think part of me wanted to just summarize, a year's worth of podcasts or client notes and letters that I'm being active in publishing and creating, not content, but information to wade through the noise. And but where does that leave us in 2026 outlook? We enter 2026 responsibly bullish. Themes we're constructive on: energy, precious metals, copper materials, international equities, defense and aerospace, infrastructure, utilities, high quality fixed income, finally attractive again, and select private markets, disciplined and structured first. Themes we approach with caution: speculative growth, leveraged private credit, anything offering monthly liquidity backed by illiquids, and strategies sold on yield rather than structure. Portfolio posture: diversified, globally aware, inflation hedged, commodity sensitive, quality biased, liquidity conscious, and risk managed. We are not swinging for home runs. We are playing the long game with discipline. Guys, 2025 was a year where fundamentals mattered again, where real assets shined, where discipline paid off, where poor structures were exposed, and where clients who stayed the course were rewarded. As we enter 2026, our message is clear. We don't chase markets, we build portfolios. We don't react emotionally, we execute with discipline. And we don't follow trends, we follow process. MLD's advantage is people, process, and philosophy. And thank you for joining us, and thank you for your trust, and thank you for being a part of MLD Wealth family. I'm Chad Larson. This has been our 2025 year in review and 2026 outlook. I look forward to speaking with many of you through the holidays. I wish you and your family nothing but health, happiness, and blessings, and have a wonderful year. Take care.